You think the global economy is finally turning around and your hard-earned savings account is completely safe just because a couple of massive technology mega-cap stocks are pushing the broad stock market indices to historic all-time highs, but the absolute reality is you are quietly walking directly into a massive structural trap while the financial elites prepare for a historic wealth transfer right under your nose. If you are tired of watching your hard-earned capital slowly melt away while sneaky inflation devours your raw purchasing power month after month, then pay close attention, because today we are tearing down the absolute illusion of this over-leveraged bull market and giving you the exact step-by-step blueprint to protect your future. Before we dive into the 5 explosive macroeconomic themes that will completely redefine global markets by the end of late 2026, I need you to do one single thing right now to prove you are actually serious about your own financial freedom journey. Drop a comment below with your exact age and the precise dollar amount you are realistically committing to automatically invest every single month through your brokerage account or your Roth IRA, even if it is just $50 or $1,000, because building real wealth is entirely about personal discipline and absolute consistency. Type it in right now so we can hold each other accountable as an elite community, because the true secret to financial freedom is time in the market and never trying to time the market like a gambling retail degenerate who loses everything. Look at what the smartest capital on earth is doing right now while regular people are blindly chasing the hype and getting absolutely slaughtered. The traditional value giants are currently sitting on historic staggering cash piles just off to the side, completely refusing to deploy it into these heavily overvalued markets. Think about that for a second. The greatest financial minds in human history would rather earn a basic yield on short-term government treasury bills than chase the artificial intelligence and quantum computing hype cycles at these current insane market prices. Why is the smart money refusing to buy here? It is because by every single objective macroeconomic metric, the stock market is wildly overheated and completely disconnected from actual economic reality. The historical evaluation metrics, which measure the inflation-adjusted price-to-earnings multiple of the S&P 500, have skyrocketed past their historical normal baselines of 18 to 20 and are now officially sitting at the second highest peak in entire human history, only trailing the literal madness of the 1999 dot-com bubble. Even worse, the total market capitalization of total market indices compared directly against the gross domestic product of the United States is currently flashing an emergency red alert at an insane 230%. Historical macro context tells us that whenever this specific economic ratio passes 140%, the market is deeply entering a dangerous bubble territory. We have never seen the total valuation of corporations disconnect from actual economic production on this massive scale ever before in modern economic history. But here is the cold hard truth you need to internalize right now. You are not a billionaire institution, and your personal retirement timeline cannot afford to just sit completely in cash for the next 5 years while inflation erodes your liquid net worth. If you are too conservative and panic sell everything into cash, you risk letting your portfolio stall out completely while core industries scale. But if you are too aggressive and buy overvalued tech names at the absolute top of the cycle, you risk an absolute portfolio demolition during a sudden market flip. The key to financial survival is positioning your capital into the specific high-growth infrastructure plays that have real commercial backing while ruthlessly automating your savings and living like an absolute minimalist. Let us look at the 5 major technological themes driving structural gains into late 2026 and the exact stocks positioning to lead them. Theme number 1 is artificial intelligence infrastructure and core hardware power. The flashiest software applications are completely useless without raw accelerated compute power. And that is why pick-and-shovel hardware groups are an absolute standout play right now. As an AI cloud infrastructure powerhouse that scales graphics processing unit factories and data center footprints across continents, these corporations are experiencing massive revenue surges year over year as demand for AI cloud capacity explodes, making them the ultimate infrastructure provider for the modern digital era. Theme number 2 is quantum computing, which is the inevitable next frontier after traditional silicon chips hit their physical limitations. The top enterprise names in quantum systems are actively securing major contracts and quantum networking partnerships across multiple industries. While the entire quantum space is highly speculative and subject to extreme volatility, these tech leaders hold the structural intellectual property that will scale rapidly once enterprise adoption accelerates. Theme number 3 is physical AI and advanced industrial robotics. Because the digital world must eventually automate the physical world to maintain corporate margins, the dominant players here build AI-powered robotic warehouse systems for global retail giants, possessing massive multi-billion-dollar multi-year backlogs of contracted orders that give them incredible revenue visibility, which completely shields them from short-term consumer spending downturns. Theme number 4 is space infrastructure, which is rapidly evolving from a scientific playground into a massive industrial growth sector. Leading space systems corporations have successfully transitioned from basic launch setups into end-to-end global infrastructure assets, building satellites, defense communications components, and lunar infrastructure that will power the global orbital economy over the next decade. Theme number 5 is data center physical expansion and thermal cooling management. Look at the reality. High-performance AI data center racks pull up to 100 kilowatts of power, each creating massive thermal densities that would literally melt traditional servers. Specialized liquid cooling networks sit directly at the center of this massive demand wave, providing the power distribution units and critical electrical infrastructure that every single hyperscaler on Earth is forced to buy in order to keep their advanced chips alive. These physical infrastructure plays are the literal foundation of the modern tech economy, but to successfully build wealth around these themes without getting absolutely slaughtered by market volatility, you must understand the broader macroeconomic reality. Look at the cold, hard numbers hitting the tape right now. Consumer prices are accelerating at an alarming rate with the headline index, logging a massive 3.8% year-over-year jump, while monthly core figures are stepping up by 0.6%, which annualizes out to a terrifying pace, well north of 6%. Your actual cost of living is compounding aggressively behind the scenes, with domestic energy baselines up 17.9%, retail transportation fuel up 28.4%, and core grocery staples like wholesale beef skyrocketing 14.8% in a matter of months. While the establishment talking heads tell you that everything is fine because corporate nominal revenues are growing, the Bureau of Labor Statistics explicitly confirms that real hourly wages have dropped by 0.3% over the last 12 months, meaning the working class is actively taking a structural pay cut while the raw purchasing power of your local paper. Currency is being systematically dismantled by state printing operations. The domestic producer price index is flashing an even darker warning signal, stepping up by a massive 1.4% in a single month, which projects out to an annualized wholesale inflation rate of nearly 15%. When production materials and wholesale inputs rise by 6% annually, it is only a brief matter of weeks before corporations are forced to pass these exact structural costs directly down to the retail consumer. This persistent inflationary environment has effectively obliterated any realistic statistical probability of domestic interest rate cuts. In 2026, instead, institutional swap markets have rapidly shifted to price in a 50% probability of an aggressive interest rate hike before the final quarter of the year. The central bank is deeply divided internally, with historical internal policy dissents reaching levels not seen since 1992, as monetary officials realize they are completely trapped between a slowing real economy and accelerating structural inflation. When 10-year government treasury yields sit at 4.59%, while real trailing consumer inflation runs at 3.8%, your true net real yield on so-called safe sovereign debt is a pathetic 0.79% before accounting for income taxes, meaning the bond market is structurally locked into a state of wealth destruction where liquid capital goes to die. Look at the structural differences between this current macroeconomic environment and the historical dot-com boom of 2000. Back then, the internet bubble was built largely on subjective expectations, retail hopes, digital web pages, and unmonetized online eyeballs without massive real-world physical capital expenditure backing it up. But today, the technology boom is deeply integrated into the real physical macroeconomy through unprecedented infrastructure spending that is radically altering regional power grids, demanding immense municipal water supplies, and transforming heavy industrial construction across the entire country. Because the capital deployment is tied directly to physical data center assets, electrical infrastructure grids, utility providers, and real estate development, any potential structural correction will not be isolated to a single speculative tech sector. Instead, it will trigger a widespread macroeconomic hangover that ripples across manufacturing networks, commercial banking institutions, and local employment markets, meaning that everyday individual investors cannot simply hide in traditional non-tech defensive value sectors to escape the structural pain. The systemic risk is further amplified by escalating geopolitical blockades in critical global transit choke points, like the Strait of Hormuz, where roughly 20% of the global petroleum supply passes daily. The ongoing naval friction has pushed international crude benchmarks toward $100 per barrel, representing a massive 60% energy cost spike that acts as a structural tax directly on the pocketbook of the global consumer. While international summits conclude with zero concrete policy breakthroughs and protectionist rhetoric accelerates, the time horizon for elevated global energy prices must be extended indefinitely, forcing real corporate margins into a tight squeeze as operational input costs remain structurally higher for the foreseeable future. This top-heavy market architecture is incredibly fragile with a massive concentration of total index market capitalization and total corporate earnings relying entirely on a tiny handful of high-performance semiconductor and infrastructure firms. Chip manufacturing equities have scaled to represent a staggering 17% of the entire broad SP 500 index, compared to a minor 3% baseline just a decade ago, indicating that the entire retirement landscape of the modern public is heavily exposed to a single hypercyclical industrial sector. While nationalistic protectionist supply chain domestic policies are temporarily inflating the valuations of domestic foundry operations to over 100 times current trailing earnings, the underlying cash flows are entering a consolidation phase that historically precedes a massive contraction. Look at the major enterprise cloud providers, where massive spending commitments toward external software foundations and infrastructure architectures make up nearly half of their entire forward revenue backlogs, creating a highly circular economic feedback loop where venture capital allocations and hardware corporate revenues are essentially being recycled within a closed corporate ecosystem. When a market becomes this structurally dependent on a highly concentrated circular income stream, the slightest earnings disappointment or capital expenditure slowdown from a couple of dominant players will trigger an immediate widespread repricing across the entire economic board. So what can you actually do about it right now as an individual retail investor to protect your capital and build a real financial fortress? I think there are 3 concrete rules you must execute immediately. Number 1, you must stop acting like a retail consumer and start acting like an asset owner. Stop wasting your hard-earned capital on mindless lifestyle inflation, luxury clothing, and impulse electronics purchases. If you can commit to extreme minimalism, live significantly below your means inside a simple, modest apartment or a basic house, and drive a reliable, old, fuel-efficient 2006 car instead of a financed luxury vehicle, you instantly free up the necessary surplus cash flow to feed your investment machine every single month. Number 2, you must ruthlessly automate a dollar-cost averaging strategy into low-cost equity index funds, like VU, which tracks the top 500 largest corporations in America, alongside high-quality dividend growth funds like SHD. Automated investing completely removes human emotion from the equation and ensures that you are constantly accumulating shares at a statistical discount. Whenever the market dips, remember that historical data proves time in the market will always beat trying to time the market. And number 3, you must maximize your tax efficiency by routing your monthly investments directly into a tax-sheltered vehicle like a Roth IRA. Inside a Roth IRA, your investment portfolio grows entirely free of capital gains taxes, and your future retirement withdrawals are 100% tax-free, allowing your capital to compound exponentially over decades without handing a single dollar of your investment profits back to the state. The entire modern economic matrix is structurally designed to reward the people who own productive assets while punishing the people who simply store paper currency in a basic checking account. Look at the reality on the ground. Corporate layoffs are accelerating across major tech, financial, and media sectors, while everyday living expenses, groceries, utilities, and insurance premiums are spiking. Do not fall for the illusion that everything is perfect just because a few mega-cap stocks are keeping the broad indices afloat. Your personal savings rate, your consumption discipline, and your consistent monthly investment strategy are the only variables you have direct control over in this chaotic environment. Stop waiting for the Federal Reserve to cut rates or for the government to fix the economy. Use this macroeconomic data to motivate yourself to stay disciplined, keep executing your dollar-cost averaging strategy, and keep moving in the right direction toward your ultimate financial freedom. You must realize that no one is coming to save your portfolio except you. The global macro environment will continue to reward the disciplined asset owners while completely pulverizing the retail consumers who insist on buying liabilities. Look at the history of modern finance, and you will see that market volatility is not a bug. It is a feature designed to shake out weak hands and transfer wealth to those who understand structural trends. When you automate your monthly contributions to low-cost index funds like VOU, you are essentially buying a small piece of American economic ingenuity every single time the market drops. When you add a defensive yield layer like SAG, you are building a passive income fortress that compounds automatically behind the scenes. And when you protect all of those gains inside a tax-sheltered vehicle like a Roth IRA, you are legally keeping the state out of your retirement wealth. This is not a game of luck or timing. It is a game of strategic positioning and mechanical execution. The people who win over the next 10 to 20 years are the ones who can look past the daily panic headlines and maintain a strict monthly savings rate regardless of whether the Federal Reserve raises or lowers interest rates. If you can master your internal impulses, master your monthly cash flow allocation, and stay aggressively focused on accumulation, you will inevitably separate yourself from the vast majority of regular people who are constantly stuck in the corporate hamster wheel. Do not let the system dictate your personal financial trajectory. Take full accountability for your capital today and start scaling your investment engine. The true differentiator between those who achieve genuine financial autonomy and those who remain perpetual wage slaves to the corporate matrix is the ability to entirely suppress short-term greed and focus on the unsexy reality of consumption control. If you are letting your monthly expenditures scale at the exact same rate as your income growth, you are fundamentally running on a financial treadmill that will keep you trapped regardless of how many high-growth themes you identify. The elites understand that liquid capital is an economic weapon, and they are currently conserving that weapon by building historic cash buffers while regular retail investors deploy their last dollars at the absolute maximum of the valuation cycle. Break free from the consumer conditioning, stop seeking validation through depreciating retail assets, and reallocate your economic surplus directly into tax-free wealth generation compounding vehicles that work for you while you sleep. Stay disciplined, stay consistent, and keep moving forward. Hit that subscribe button. Peace.